Focus. Ideate. Innovate. Enable. ICICI ETF and CNBC-TV18 present Smartly Passive, unlocking the world of ETFs.
Hello and welcome to CNBC-TV18 and ICICI ETF presents Smartly Passive, unlocking the world of ETFs, a masterclass that delves deep into the world of passive investing. Through the show, get insights from industry experts and discuss strategies on how to enhance your portfolio with ETFs. Exchange-traded funds are essentially a type of investment vehicle that track the performance of a stock market index, and today our focus is on how one can build a robust portfolio with ETFs. Basically, portfolio creation involves selecting a mix of financial assets to achieve an investor's specific financial goals while managing risk through diversification. A well-constructed portfolio needs to balance risk and return according to the investor's risk tolerance, time horizon, and investment objectives as well. As we promised, we'll help you decode complex jargons and give you some useful investment advice. And for that, we have with us joining today Amit Bivalkar, the founders of Sapient Finserv Private Limited. Amit, good afternoon. Thank you so much for joining us today. It's always a pleasure speaking with you. And there's so much conversation around ETFs. So globally, ETFs have opened a whole new world of investment choices for both retail and institutional investors. And there is a change in the passive investment outlook in India as well. But going forward, how do you perceive the role of ETFs in changing the overall investment landscape? There are big trends on the horizon.
Yeah, thanks, Sonal, for having us on the show. This is a very new kind of investment vehicle, what we are seeing in the last 5-6 years. The rising awareness and education of this is catching up very fast, because it is cost efficient. Exchange traded funds are cost efficient. I think you've got transparency and diversification, which it offers. Also, adoption rate, I think, is going to go up. The educational incentives and initiatives by market participants and the regulator are crucial in this. If you try to look at, Sonal, the regulatory support on this, I think a big move which SEBI did was allowing the EPFO, or the Employees Provident Fund, to allow to invest in ETFs, and thereby encouraging the retail participation through initiatives like Bharat Bond as well. So if you look at the EPFO and the Bharat Bond ETF, I think those were significant steps which on the regulatory side we have seen. Institutional participation, I think more pension funds, more insurance companies, more mutual funds, they are increasingly incorporating ETFs into their portfolio. I think this trend is likely to continue, given A, the cost advantage, and B, ease of access to various asset classes. The second question what you put was the role and emerging trends what we see in the ETF. I think diversification of ETF offerings, we have seen that the range of ETFs which are available in India, it is expected to expand beyond the traditional equity and debt ETFs. We might see more sector specific, like you have a EV auto ETF which is being launched. You will see more of sector specific, you will see thematics, and you will see a lot of smart beta ETFs, Sonal. This diversification actually will allow investors to maybe target specific investment strategies, such as, say, ESG, or maybe healthcare or technology. So overall, I think that the trend is on the up. Technological advancement definitely makes their mark, and therefore liquidity and cost efficiency are created. I think enhanced liquidity and market depth is also something what we are seeing in the ETFs. So overall, very positive, and going forward, I think the passives will have a larger say in the overall allocation in a portfolio.
Okay, passive will have a larger allocation in the overall portfolio. But, Amit, each investor is unique with their own goals, investment needs. So how can one go about building an ideal portfolio? How do you customize, say, ETF portfolios for different types of investors, say a retiree versus a young professional?
I think very good question, and it's like this, that you have a choice for all type of investors when it comes to ETFs. So now if you try to look at a typical retiree investor, then what is he looking for? His goal is basically income generation, or his goal can be capital preservation, or his goal can be minimizing the volatility of the market. The risk tolerance of such an investor as a retiree is typically lower, as they might be relying on their investments for their living expenses. That is point number two. And point number three, although they might have a long uh, investment horizon, their immediate need of income and lower risk are the critical consideration when you think of a retiree investor. So for that, you can have maybe a dividend ETF. You might have an income-oriented ETF. You might have a capital preservation ETF. You might have a low-vol ETF, which can solve the problems of the retiree as an investor class. Uh, you might also see inflation protected ETFs which might come into the market. I think for retirees that also can make a big difference. Then the second one as a category you can see is young professional. His goals clearly are wealth accumulation, growth, and long-term capital appreciation. His time horizon definitely is long-term, which means that he can allocate more money to higher risk and higher reward investments. If you look at the risk tolerance, as they have a longer time horizon, they can withstand the short term volatility of the market. So, for them, you might want to look at a growth oriented ETF, maybe a broader market ETF, maybe a sector or a thematic ETF. Uh, just to give you a perspective or as an example, the new generation might be interested in, say, a renewable ETF and all of that. So depending on the type of investor, you've got a lot of choice when it comes to looking at ETFs for different classes of investor types.
You know, there are a lot of options. With that also comes a lot of risk. So it's important to address that as well, Amit. How do you approach risk management when it comes to ETFs, right? And what are some of the common misconceptions about ETFs that an investor should be aware of?
So there are a lot of common questions which generally the mutual fund investors or ETF investors have. I think first is that are ETFs safe? ETFs are basically they hold the underlying assets, and therefore they offer diversification. They if it's a index ETF, it just mimics the index, which can reduce risk compared to overall holding individual stocks. However, they definitely carry market risks, and it is essential to understand the strategy of each ETF and its holdings. Uh, the cost associated with ETFs, people say that are the costs, there are some hidden costs in ETF. The answer is no. There are no hidden costs in an ETF. The costs include the expense ratio, which covers the management and operational expense, and brokerage commissions for buying and selling of ETFs. That might be the cost what you will incur. Some ETFs also have this bid ask spread, which means technically the difference between the purchase and sale price. So you might have some illiquidity premium or discount which might go into pricing of an ETF when you're trading it on the exchange. So be aware of what is the bid and ask spread, what you are going to do when you are buying or selling a ETF. Apart from that, I don't think so that you have any more difference between a mutual fund and a ETF, except that a ETF can be bought during the day, while a mutual fund, you get the NAV at the end of the day.
That makes sense, and that is one of the most important differences here. So, Amit, how do you adjust your ETF portfolio strategies based on the changing economic and market conditions? What are the primary indicators that you consider making informed decisions about adding or maybe removing ETFs from your portfolio?
Uh, like you hear a lot of talk currently on mid caps and small caps being overvalued. I read a lot about that on the on Twitter, on news channels. I read about it in the newspapers. You might want to trim your mid and small cap portfolio at this juncture. Getting rid of a ETF is very easy. One is that you start with your risk tolerance, then you do your asset allocation, and when you do your asset allocation, you have to maintain that percentile at least once a year. Getting out of a mutual fund is as easy, but getting out of an ETF is much more easier. Why? Because when you sell an ETF, the money lies in your account with the broker, and you can utilize that money the next day to buy into other ETF, which might be a debt ETF if you're coming out of an equity today. So this pooling concept of an individual portfolio when the money lies with the broker, this makes it very easy. And therefore, Sonal, along with this, you have a lot of fund of funds also which will come, which will have a lot of ETFs as their underlying. The taxation on that in the budget has become very pro investments, and therefore you will see a lot of AMCs which will launch a 50% equity, 50% debt ETF in a fund of fund structure, or a 75 debt, 25 equity. So you'll get a lot of combinations which will come in the next 6 months on the mutual fund side for ETFs. So asset allocation and changing the asset allocation, that becomes a priority in such kind of markets, and ETFs can be very well thought through when you're going to do a asset allocation bit.
Okay, all right, take that point. Amit, we will continue this chat, but we have to get into a quick commercial break. We'll just do that and come back in a bit with more tidbits and more expert advice coming in from Amit.
ICICI ETF and CNBC-TV18 present Smartly Passive, Unlocking the World of ETFs. ICICI ETF and CNBC-TV18 present Smartly Passive, Unlocking the World of ETFs.
Welcome back. You're tuned into CNBC-TV18 and ICICI ETF presents Smartly Passive, Unlocking the World of ETFs. And still with us is Amit Bivalkar, the founder of Sapient Finserv Private Limited. Amit, you know, we spoke about a lot of things, some of the risks you can consider, the differences, and how can one go about balancing their portfolio as well. But how do you advise clients to navigate market volatility when investing in ETFs? Are there specific ETF sectors or themes that you can recommend during volatile market conditions?
I think a good question, and we should be very much aware of the risks before making any investment call. It's always good to have one check on the risk while you are looking for rewards. During volatile markets, I think more important is to emphasize of maintaining a long-term investment perspective. Market volatility is often short-term, and staying invested can help clients benefit from eventual recoveries in the market. That's the long-term focus that you should have. Second one, Sonal, is the diversification bit, that when you ensure that your portfolios are well diversified across asset classes like precious metals, you have got gold, you've got silver, you've got sectors, different sectors, like you have got a EV, auto, defense, pharma, healthcare, all of those. Then you have got various geographies, Sonal, where you can mitigate risks associated with the specific market segment. So you can go beyond India, you can go into China, you can go into US, you can go into emerging markets, you can go into commodity funds, ETFs. I think that is on the diversification bit. The third one is the rebalancing. I think regularly rebalance the portfolios. That's what we do to maintain the desired asset allocation. And that's how you can actually look at managing somewhat the risk element. The fourth one is that quality investments. Focus on high quality ETFs that track well established indices. There are many ETFs in the market which track some of the indices which do not have liquidity. So while ensuring stability in the portfolio is very, very critical during market turbulence, I think therefore we focus on high quality ETFs that track well established indices. And the last but not the least is that in periods of heightened volatility, one should consider to move to more defensive sector or low volatility ETFs. So you've got some ETFs which are low vol, some which are precious metals ETFs, some which are short-term bond ETFs. So I think you can have a mix and match of these, and therefore you can be looking at reducing your volatility when markets are acting as they are today.
Okay, so you know, since it is a product which not a lot of people are looking at or investing so far, but there is gaining popularity here. What are some of the common questions you get from your clients when it comes to ETFs, Amit, and how do you address them, because they would be different from what we see with mutual funds?
I think there is no major difference when it comes to a mutual fund and a ETF. It's just that one is traded on the exchange, it is available throughout the day, while the other is available at a day-end NAV, and you can also participate via index fund in whatever ETF you're doing if the ETF is tracking an index. An ETF definitely adds more value to a portfolio because of the operational costs. The costs in the ETFs are very, very low. If you look at, like, there is a momentum ETF, there is a high quality ETF, there is a low vol ETF. So you can get actually many strategies which are not available in a normal mutual fund, which you can avail on the stock exchange through the ETF. You require a demat account. People are not aware of that. In order to buy a ETF, you require a demat account, and there will be a brokerage charge which your broker will charge you. Most importantly, what we advocate to our clients is that when you're looking at a ETF, focus on a high quality ETF which track the broad index if you're doing through the index. And second is that look at the bid ask spread. If the bid ask spread is too far, then the impact cost on the portfolio can be very, very high. So look at high quality ETFs, and look at the impact cost, and look at the brokerage cost. I think these three things are the common questions which the clients put, and we answer it accordingly.
Okay, we get that totally. That's very helpful, Amit. But in case we are talking about appropriate allocation, how do you determine that within a diversified portfolio? And what about international ETFs for geographical diversification? How can an investor go about that?
Uh, One thing is that if you look at Japan, if you look at Korea, if you look at US, these guys, the markets have delivered returns there over the past 30, 40, 50 years because companies there have grabbed global market share. Apple sells in almost the entire world. You look at any big company, they actually have a market share in the entire world. So if you want to participate in the growth of a company which is listed outside India, then you need to put your money into that stock. But putting that, instead of that, if you put it in a ETF, which is a global market ETF, I think you can capture the best of the companies across the globe. So allocate a portion of your portfolio to international ETFs. Why? To capture growth opportunities outside the domestic market, and also to reduce your country-specific risks. Second is that you can go in for a regional or a country-specific ETF. Consider a mix of maybe a developed market and a emerging market ETF, and accordingly evaluate the regional or the country-specific ETFs for target exposure. And the third one is when you're doing an international exposure here through the ETF, just remember that there is a currency consideration which should be considered. You should be aware of the currency risk and consider hedged ETFs if current volatility is a concern. So these are the three things what you should actually look for, Sonal, when you're looking at diversification geographically.
Very interesting. And Amit, the next question that I have is a little personalized, but I want to understand because that is a question that a lot of clients must be asking as well. Any specific examples of ETF combinations that have worked well for your clients you think can benefit more number of viewers as well?
So first is you need to have the risk tolerance of the customer done, and sample allocation. Like we were discussing about the retiree as an asset investor class. Now, if you look at a sample allocation for a retiree, clearly a 40% allocation, Sonal, can go towards income-oriented ETFs. These can be dividend ETFs. This can be high-yield bond ETFs where the person can invest his money. Maybe 30% can go into capital protection ETFs, which will be essentially your treasury bond or corporate bond kind of ETFs. 20% can go into a low volatility ETF, and 10%, whenever that gets launched, I think we can go into a inflation protected ETFs. Some of our clients, Sonal, have sold their jewelry when they have become at 70, 75, 80 years of age, and they have converted that money into a gold ETF or a precious metal ETF because they said we are not able to go to the bank. We want to give this gold to the next generation, and the best way to do that is instead of the ornaments, why can't we put money in the precious metal ETF? That is there. Most of the asset allocator funds, they also have oil now in the portfolio. So you can do a commodity, you can do a protection, you can do a income generation, you can do a low volatility, you can do all sorts of things. But generally what people prefer, income generation, capital preserving, low volatility, and a precious metal. That's what we have also been suggesting to our customers.
That's such an interesting combination. And talking about the older generation converting their physical gold to ETFs, that's something very new, but changes, they take place every generation, right? But there's so much happening in the ETF space. There are a lot of innovations. What are you most excited about, Amit? You've seen regulatory changes. How is that impacting growth and structure? Is AI and technology influencing ETF selection and portfolio management as well?
I think two, three things. One is that the budget has given a boost for making a fund of fund, as I said already. So you can do a combination of ETFs domestic, and you can have a great tax efficient return if the product delivers well. The regulator has always been here for increased transparency. And I think regulations promoting greater transparency in ETF fees and holdings can actually enhance more of investor confidence and trust. Uh, I think market accessibility is something which we should look at, that the regulatory changes, they can facilitate easier access to international ETFs, and that can actually promote a lot of global diversification. The third one, which I feel, is that the support for ESG. Europe as a continent, you have seen a lot of demand for these ESG ETFs, and slowly it is trickling across India as well. So for ESG disclosure, for standards in the balance sheets, disclosure standards, these can boost the growth of ESG focused ETFs as well. On the AI and technology in the ETF selection, or rather selection and portfolio management, what I believe is that you'll have a lot of robo advisors. These automated platforms, they are using AI right now to construct and manage ETF portfolios based on the individual investor profiles. And they offer personalized and cost-effective solutions. So definitely the robo-advisory platforms, they are using a lot of AI and individual investor profile to create customized ETF solutions. Then you have got some of the insights. So AI is actually an enabler to look at a lot of data. And machine learning can be used to analyze vast amounts of data quickly and providing insights into, for example, market trends, sentiment of the market, and also optimal asset allocation. So you can use AI ML in this. And third and most crucial, I think that AI ML should be used to actually improve your risk management by identifying potential risks and opportunities faster and probably more accurately than the traditional methods.
Yes, the world is changing so fast, right? So we have to keep up with our investments as well. Amit, always a pleasure speaking with you. Thank you so much for joining us today and sharing your valuable insights about portfolio creation with ETFs for different investor needs. The show's aim is to empower the audience to make more educated investment decisions. Thank you, Amit, for joining in. With that, we'll take your wrap on this edition, but stay tuned for the next masterclass.
ICICI ETF and CNBC-TV18 present Smartly Passive, unlocking the world of ETFs.
Focus. Ideate. Innovate. Enable.